45% of retirees will run out of money when they're retired. And if Congress does absolutely nothing, in the next 6 years, Social Security benefits are projected to be cut by 25%. So naturally, people are going to ask, what is my retirement number? Is it $500,000? Is it $1 million? Is it $2 million?
Today I'm going to show you exactly what each of these numbers look like in real life, including the part that most people forget, and that's taxes.
Let's start with $500,000. Actually, let's start with $609,000 because that's the average retirement balance across all retirees. It would take you investing $427 a month from ages 30 to 62 to get to $609,000. This is assuming average rate of return of 7% per year. Now, if instead you did this from ages 30 to 70, that would drop it down to $232 per month. And 62 and 70 are going to be the most common ages for retirement because at 62, that's when you become eligible for Social Security, and at 70, that's when you would hit your max payout that you can get from Social Security. Additionally, at 62 and at 70, you would withdraw different amounts from that same retirement balance. Now, despite what you may think, you don't just divide your retirement balance by your average life expectancy. Instead, what you do is you either use a 4% safe withdrawal rate or a 5% safe withdrawal rate. 4%, you could expect to have that money for the next 30 years, and at 5%, you would expect to be able to have that money for the next 20 years. So if you retire at 62, you would use a 4% withdrawal rate, and if you retire at 70, you would use a 5% withdrawal rate. That means that if you retire with $609,000, at 62, you could withdraw $24,000 a year, and at 70, you could withdraw $30,000 per year. Now let's factor Social Security into this as well. The way that Social Security gets calculated is it takes your highest 35 years of earning and averages out what that salary is. We'll assume, based on what you're retiring with, that you averaged out at $40,000 per year. In that case, if you retired at 62, your Social Security payout would be about $15,000 a year, and at 70, it would be about $26,000 per year. But as I mentioned in the beginning of this video, it's expected that benefits are going to be cut by 25%, so we want to factor that into this as well. That would bring you down to $11,000 at 62 and $20,000 at 70, for a grand total of $35,000 at the age of 62 and $50,000 at the age of 70. Now, most people aren't intending to retire with $609,000 or even $500,000. Really, what most people would say is they need at least $1 million. The reality is about 3.5% of retirees actually make it to $1 million in their retirement account. So let's talk about what it would actually take to retire with $1 million. Again, I'll assume that you start saving retirement at the age of 30, and if you wanted to retire at the age of 62, that would require you to invest $700 per month. Retiring at 70 would mean that you would need to invest $381 per month. And if you did make it to $1 million, that would mean at 62, you could withdraw $40,000 a year, and at 70, you could withdraw $50,000 per year. Now, we'll also assume that because you made it to $1 million, you probably were making more than you would have if you made it to $609,000. So in this case, we'll assume that you are making $80,000 per year, and we'll base your Social Security benefits off of that salary. At 62, you could expect about a $23,000 payout, but if your benefits were cut, that would bring it down to $17,000 per year. And at 70, that would be $41,000 a year, but if we adjusted, it would be closer to $30,000. Now you're looking at being able to have $57,000 at the age of 62 or $80,000 at the age of 70. Lastly, let's talk about $2 million, because $2 million is beyond safe. This is when you can actually add a lot of flexibility into your retirement life. And in case this comes off as an intimidating number, just know that less than 2% of people actually make it to $2 million. And that's because it would take $1,400 a month invested from ages 30 to 62, or $762 invested from ages 30 to 70, which maybe seems like you could do for the course of 1 year, but doing that over the course of 30 or 40 years is extremely difficult. But let's say you did make it there, you'd be able to withdraw $80,000 at the age of 62, or you'd be able to withdraw $100,000 at the age of 70. And again, because you were able to invest that much we'll assume that you are making more than you did in the previous example. We'll say that you're making $150,000 per year. If you took your Social Security benefits at 62, then you would be receiving $32,000 a year. Adjusted, it would be closer to $24,000. And at 70, you would be receiving $56,000. Adjusted, it would be still $42,000. Now you're living on $104,000 at 62 or $142,000 at the age of 70. That's a pretty insane salary to have at that age. Unfortunately, we have left out a really tough part of this conversation, and that's taxes. All of these scenarios can shrink pretty massively if you start to play out these tax scenarios. And the three most common tax scenarios are Social Security taxation, RMDs, or required minimum distributions, and Medicare premium surcharges, or IRMAAs. It turns out that Social Security income is not tax-free. Well, at least not if you make too much money. I'm going to play out a few of these tax scenarios for you, assuming that you are married and filing jointly, just to make this video a little bit more simple. Now, the way that Social Security taxation works is a bit unique. You don't necessarily get taxed on 100% of the money that you receive. It can be anywhere from 0% to 50% to even 85%. And that doesn't mean that for every $1,000 that you'd receive, you'd have to pay $850 in taxes. It means that if you received $1,000, you'd either get taxed on zero of it, you'd get taxed on half of it, or of the $850 that you're getting taxed on, you'd get taxed on at your effective tax rate. But let's run this scenario out for each of the situations. For the group that's 62 and has $609,000, they are receiving $11,000 in Social Security income. 50% of that $11,000 would count as earned income, so $5,500, on top of the $24,000 that they are also pulling from their retirement account. So their total taxable income would be $29,500. Now, the first $23,850 that you earn as a married couple is taxed at 0%, which means that they would pay 12% on that additional about $5,600 for a total of $678 in taxes. This isn't nothing, but you're probably not going to really notice a huge impact on taxes in this situation. Now, the group that's 70 years old is getting $20,000 from their Social Security. So again, they would fall into the 50% bracket, which means that $10,000 of that $20,000 would be taxed or counted as earned income, on top of the $30,000 that they already made. So for a total of $40,000 in earned income. That means that they would pay a 12% tax rate on the roughly $16,000 above that $23,000 deduction, which means they would pay almost $2,000 in taxes over the course of the year. Again, this is probably not going to be life-changing taxes. In all of these examples, I am neglecting state income tax. That could add an additional $300 to $400 for each of those situations. Now, for the $1 million and $2 million group, they're no longer in the 50% taxable Social Security. They move up to having 85% of their Social Security income becoming taxable. That means that the 62-year-old group has $54,000 in taxable income. They would pay a 12% tax on roughly $30,000 in income. And so the total tax that they would pay throughout the year would be $3,600, and it would knock their income down to about $53,000. The 70-year-old group would have over $75,000 in taxable income. They would pay 12% on about $51,000 of that income for a grand total of over $6,000 over the course of the year, dropping their total income to $74,000. Now, the $2 million group really sees an impact from taxes. And that's because in this scenario, they actually enter into a 22% tax bracket. The 62-year-old group would end up paying $10,000 in taxes, dropping their total income from $104,000 to about $94,000. And the 70-year-old group would pay $17,000 in taxes, dropping their total income from $142,000 to $125,000 per year. Now remember, this is just looking at Social Security taxation and taxes on your income. This doesn't factor in required minimum distributions, which take into effect in your 70s and 80s. In your 70s, you would be forced to withdraw about 4 to 5%, and in your 80s, you're forced to withdraw 7 to 8%. Now that 4 to 5% or that 7 to 8% is all withdrawals on your retirement account. That's money that you have to be taking out of your traditional retirement accounts every single year. That means that in your 70s, on the $1 million or $2 million portfolio, you'd be forced to withdraw $40,000 to $80,000. But in your 80s, you could be having to withdraw up to $160,000 per year, which really can drive up your taxes. And those RMDs can actually push you into Medicare premium surcharges. Now, Medicare premium surcharges are just increase in the premium that you have to pay if you cross certain income thresholds. Most of the people on this list are not going to have to worry about this, and that's because a married couple filing jointly would actually not cross into that until they hit about $216,000 in income. The only time that this would become relevant is if for some reason they did a bunch of Roth conversions, or if they were widowed and making withdrawals on that $2 million portfolio, because instead of being $216,000, that threshold would actually drop. For all three of these taxes, this is why investing in a Roth IRA is so important. The Roth IRA is so great because you don't get taxed on the withdrawals. It doesn't actually count as earned income, which means that it's not going to increase how much you get taxed on your Social Security. And the last thing is there's no RMDs for a Roth IRA, so you're not going to get pushed into a higher tax bracket. For every single group in this video, they would end up paying $0 in taxes if their retirement account was a Roth IRA, because they would have such little income, they actually wouldn't trigger any sort of Social Security taxation. And if you're someone who does have a ton of money in a traditional IRA and you're worried about being taxed on that, well, the things that you could focus on doing is converting during low income years, converting before you take Social Security, and converting during market downturns where it actually would cost you less to convert that money to a Roth IRA. If you're trying to figure out whether or not you're gonna have enough money at retirement, just keep in mind that the average retiree spends about $60,000 per year. The truth is that $2 million can end up being really tight, and $600,000 can feel like way more than you need. The difference is if you have a ton of debt, if you're not controlling your spending, and if you're not using the right taxable account. Someone retiring with no debt that has their spending under control and is using a Roth IRA can totally make $500,000 or $600,000 in retirement work for them. Someone who has not been able to control their spending, someone that has a ton of debt and is going to be forced to withdraw and pay a bunch of taxes on that money, is going to end up feeling like $2 million is not enough. If this video was helpful, it'd mean a lot to me if you could like it or even share it with someone who's close to retirement or just entered into retirement. I want to help as many people as possible with their finances and reach financial stability, and so those little actions actually go a long way.